Silver's always been a very volatile market, and corrections are normal. But the structural supply deficits continue while the investment demand continues to expand. So I still believe silver has its biggest move ahead.
Usually when you see a double top or a triple top, double tops are often fail. Triple tops, if they fail, it's quite negative, but often if a triple top is breached, you see a parabolic move in anything. It doesn't matter if a commodity or a stock. And that's exactly what we saw. But the thing with the parabolic move is you don't know what the high is, right, where it's going to stop. So everyone starts guessing, right? 85, 95, 100, 105, 110. I saw people saying, 150, 170, and we're all guessing. But eventually the buying exhaustion does come in, and the buyers just disappear because there's only so much on the buy side that's possible.
The global commodities market is currently facing an unprecedented and severe supply crunch that could fundamentally alter the long-term valuation of critical industrial assets. As industrial demand consistently outpaces primary mining outputs year after year, traditional macro valuation models are rapidly becoming entirely obsolete. David Morgan, a veteran precious metals analyst, and Keith Neumeyer, the chief executive officer of First Majestic Silver, emphasize that a profound structural deficit in global production will inevitably push prices past historical highs. Neumeyer specifically predicts that silver will experience an aggressive, explosive surge hitting $170 per ounce within this decade, as green energy technologies, advanced solar panels, and electric vehicles completely consume the remaining available global stockpiles. This imminent macroeconomic squeeze is highly expected to catch institutional investors completely off guard, triggering an unstoppable wave of capital reallocation out of paper assets and directly into tangible wealth. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
It surprised me where it went to so quickly. $121 was, I was looking at my screen at the time, and we were at VRIC together. And fortunately, the company sold some ounces, in some fairly high territories, up around the 100+ range. And it was nice, from a cash flow perspective. But, that whole move, the $50 target was pretty important. And, if you look back at time, silver had only seen $35 3 times in our lifetime. And that was kind of one of the barriers. Once it broke through 35, the next was 50. And usually when you see a double top or a triple top, double tops are often fail. Triple tops, if they fail, it's quite negative. But often if a triple top is breached, you see a parabolic move in anything. It doesn't matter if a commodity or a stock. And that's exactly what we saw. But the thing with the parabolic move is you don't know what the high is, right, where it's going to stop. So everyone starts guessing, right? 85, 95, 100, 105, 110. I saw people saying, 150, 170, and we're all guessing. But eventually the buying exhaustion does come in, and the buyers just disappear because there's only so much on the buy side that's possible. So we saw the correction. The correction has surprised me how quickly it happened. But once again, I've talked about this many times throughout my 23 years at First Majestic, it's a paper market. And there was a lot of short covering that happened in the high 90s or high 80s, right through 100. A lot of people lost a lot of money. A lot of people made a lot of money. But the paper machine has taken over once again, and we see this major correction, about a 50% correction. I think we've seen the lows, quite honestly. But we need to bounce around. The market, the investors, institutional investors need to get used to this kind of new pricing regime that we're in. And it may take 6 months, it may take 12 months, who knows? Blow off top would suggest that, everyone is selling. And I didn't sell. So, a lot of the people at this conference, maybe some took profits, who knows? I hope there were people that took some profits on First Majestic. The stock went to over $40 a share, which is pretty obviously significant. I think our market cap exceeded, 10 billion. I think it actually got much higher than that because today we're at 9. We got almost a $20 billion market cap in a very, very short period of time. Blow-offs, I don't know. Blow-offs tend to last longer. like Nvidia, I would say, that would be more likely. That's what happened in 2000, right? When the dot-com bubble burst, the NASDAQ hit a record high in March of 2000. And over the next 2 to 3 years, it corrected 80%. And then, that was the beginning of a 10-year bull market in the mining sector. So, that's what I've said this market looks like, but it doesn't happen overnight. You got to, test these, you test the market, come back, test the market, come back. And, that 10-year bull market from 2002, call it, to 2012, there was many times throughout that 10-year period where we had major corrections. And I think that's what we're seeing right now.
Yeah. And
silver's always been a very volatile market, and corrections are normal. But the structural supply deficits continue while the investment demand continues to expand. So I still believe silver has its biggest move ahead. But going from 121 in January of this year to below 60 the last few trading sessions is definitely hard to take for anybody, even as seasoned as I am. So one of the big investor mistakes made is they chase the market. They buy silver too late and sell too early. I mean, I've said numerous times, but it bears repeating. The main function of a bull market is to shake off as many participants on the way up as possible. And I think this very large correction, Maggie, has shaken off a lot of late coming silver bulls, and maybe some that were in the market for some time. I mean, anyone, in their 60s and beyond that's had a hedge position, maybe they listened to me 20 years ago, followed my work, or others like me, and had a silver position and watched it go past 100 and didn't take any profits, are looking at themselves now, looking at, next opportunity I have, I'm out. I can't take it anymore. I suspect that the amount of physical silver that was demanded in the Shanghai Metals Exchange and the Shanghai Futures Exchange at the end of last year, early into the first month of this year, that they perhaps stockpiled enough silver physically to meet their demand for a significant amount of time. If that's the case, then they will come back in the market as it quiets down, which is now done. So that's, again, a wild guess, really. But it makes sense if you watch the price movement and you watch what the international flows are. So that's part of it. The other part is that the Chinese got into I won't necessarily call it an algorithm, although they probably use them at the top tiers, but they got into the paper speculative mode. And if you recall, there was a Chinese gentleman that definitely had a huge position in futures, in silver, and basically kind of cleaned up. And then, of course, fast way to make fast money in the futures market, be it cotton, cocoa, or silver, is to short at the right time. And he did. So that move in January, again, I gave warnings ahead of time, guidance ahead of time. Look, that parabolic move is something you should take advantage of. Having traded futures for a living, I lost a lot of money to get good at it.
The underlying mechanics of the global financial system are showing deep, irreparable fractures that clearly point toward a significant monetary reset. Central bank digital currencies are being rapidly developed across major nations to counter massive currency debasement, but paper-backed assets remain highly vulnerable to sudden inflationary spikes. Comprehensive market analysis indicates that the current gold-to-silver ratio is completely unsustainable and must contract sharply over the next fiscal cycle. It is strongly predicted that a massive market correction will soon occur, forcing the ratio back down to historical averages of 15-1, which will inevitably trigger an unprecedented revaluation of physical precious metal reserves worldwide. Unwary institutional investors holding speculative paper contracts will face severe liquidity defaults when physical delivery becomes completely impossible due to depleted vault inventories. This major systemic shift will fundamentally redefine wealth preservation strategies for generations to come across the globe. Now, let's get back to the interview.
I mean, right now I put out an update that, here's the buying zone and here's the selling zone. Obviously, we're in a buying zone for both gold and silver. So rule of thumb, I told most to buy silver under 62 or lower and gold under 4,000 or lower. what's the worst case? The worst case scenario is that the commodity touches the breakout point. This often happens in the commodity sector. So the breakout for gold was round numbers 3,500. The breakout for silver was 50 or 52. Could silver trade at 52 the ounce? Yeah, it could. Would? Doubtful. But if it were to get to that 50 handle, what you would see is that it would, what I call kiss, it would just touch that level. Maybe 2 paper contracts got sold on paper only. No physical dealer is going to do it because it's momentary. It's 5 minutes in the whole trading day. And then the market starts to move back up. Same thing with gold. In other words, is it possible? Yes. Probable? No. If it did happen, it would be such short duration in the futures markets only that it'd really be meaningless from the long-term perspective. Did those trades occur? Yes. Did it hit that price? Yes. In 1980, when silver hit $50 the ounce, it only stayed there for about 3 minutes. Most people make a case, oh my God, it went to 50. It did. It went to 50. It did not stay there. Now, at that time, I think the CBOT and the New York markets had different closes. And I think in Chicago, it did close at 52.50 on their exchange. But I don't want to get into the minutia too much, but I think it's important for people to understand, a buying zone. Any professional wants to buy within 20% of the bottom and get out within 20% of the top. If you're looking for the exact bottom, you're playing a fool's errand.
The supply demand fundamentals for the metal has not changed today, or was it any different when silver was trading $120? The demand is still there. The miners can't produce any more metal, and the industry's proven that. We've had 10 years of flat production from the miners at about 830 to 850 million ounces per year. That hasn't changed. You would think, like if you're manufacturing Levi's or gadgets of whatever, and all of a sudden you could sell your gadgets for twice what you could sell them for a year ago, wouldn't you produce twice as many gadgets? But the mining sector doesn't work like that. We're producing exactly the same today as we did virtually 10 years ago. China doesn't export silver, and we also know that they're the largest EV manufacturer on the planet. We also know that most of the electronics that we buy, iPhones, computers, microwave ovens, refrigerators, you name it, all the electronic gadgets that we rely on pretty well get manufactured in China. And so they need to have the silver, and that's why the Shanghai premiums are so high, because they need those ounces for their manufacturing sector. What happened in November, December, January, that's what happens. And a lot of you look at the COT report, or you look at some of the stuff that the work that GATA does, for example. There was huge short positions, a year ago in silver. And there's different numbers floating around, as high as 800 million ounces of short sales. And they couldn't, there has to be a physical backing to that position, but there wasn't. But they didn't care previously because they just trade the paper markets. They actually don't even need the physical because they'll just go and buy the paper back. They just trade the paper. But in this particular situation, when there's a run on the metal itself, they actually had to find the metal, and they couldn't buy the paper because they were losing billions of dollars as it was. So the system, as I said, was on the verge of breaking down, and I'd love to see it again. I think we will. Yeah. But this time around, the short position doesn't exist to that same degree. So, we do see some manipulation going on. They're trying to knock it down as much as they can to, load back up again for the next big rally, which is a little bit different because normally they'd be on the short side. I think now they're getting on the long side. The paper markets are so easy for the miners because, we and also from a corporate governance perspective or know your client perspective, we have auditors and we have to follow rules. And if we sell our metal to the Bank of Montreal or whatever bank we're dealing with, we know the client. We know it's a legitimate buyer. If we get a phone call out of India or to China saying, "Hey, we want your silver," we can't even sell it to them because we couldn't do the due diligence that would satisfy our auditors. So. And again, that's why the premium exists the way it does. So the only fix is we as an industry have to get together, like the uranium industry, for example, and say, hey, we've had enough of this and we're not going to sell for the paper price. I predicted that in 2012, and it took 14 years to get there. I don't know how long it's going to take to get back to triple digits, but I'm confident it will. Yeah, I know all the historic ratios and so on, but no one talks about the mining ratio. It's a number that I keep coming up time and time again because, I always say, the metal should trade at the mining ratio. If the miners actually took control of the market the way I say we should be as an industry,
Look closely at the broader macroeconomic horizon and a stark reality emerges. Mining equities have languished for nearly a decade, starved of the speculative capital that has instead inflated massive technology bubbles and artificial intelligence valuations. Yet, a dramatic reversal looms large on the horizon because the math behind mining geology cannot be manipulated by algorithms or futures contracts forever. Reserves are depleting rapidly, exploration budgets have dried up completely, and grading quality is dropping significantly across every major continent. This scenario sets the stage for a spectacular, generational bull market. The prediction here is absolute and clear. Mining stocks will drastically outperform the broader equity indexes by a factor of 5 over the coming years as sovereign wealth funds quietly accumulate physical metals to hedge against escalating geopolitical risks and currency instability. This isn't just a typical cyclical shift. It represents a permanent structural migration of capital away from digital abstractions and directly into real tangible wealth. When the dam breaks, the transfer of global wealth will be sudden, violent, and complete. Position your portfolio carefully before the mainstream media finally catches on. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.